And I think that people are not looking, and the Fed is not adequately looking. Yes, we have a big issue pertaining to inflation. You have something that could be a 5% inflation rate, and you have the supply-demand imbalance is something that is really a problem. 500 basis points lower than it was back then. There's something bigger going on. And that bigger thing that's going on is...
An economy is not a complicated thing. It just has a lot of moving parts, but the basic is there's a transaction. And that transaction means somebody makes a purchase. They make a purchase of a good, a service, or a financial assets. That purchase can be made with money or credit. If money, when you make a purchase with money, you end the transaction. You don't owe anything. When you make it with credit, then there's a liability. You have to come up with the money because a credit, that debt, is an obligation to deliver money. So there's a basic transaction. There's spending, in other words, the total amount of money and credit spent on a good or service. And then there's the item that you're buying, a stock, a bond, a car, a bushel of wheat. There's that transaction. Demand is best measured in terms of spending. I think in traditional economics, it's a mistake to measure it in terms of the quantity of goods. What is given up in a purchase is money or credit. What we go through is we go through a cycle. We go through a credit cycle. Credit can be created. It's not created through the velocity as is commonly believed. It can be created out of thin air. If I go into a store or I have somebody paint my house and I say I'm going to pay you later, well, I've created credit. That'll count in GDP. It'll be an item of production. So what we have is a credit cycle. If there's not much debt, if you don't have much debt, then you have the ability to borrow money. Let's say you earn $100,000 a year and you don't have any debt. You can then borrow $10,000 a year. You therefore can spend $110,000. Your spending of $110,000 is somebody else's income of $110,000. So it has a positive effect, and you go through a cycle. And through that cycle, you spend $110,000, they earn $110,000, and the cycle becomes self-reinforcing. Through that cycle, debt rises faster than income. Debt rises faster than income. Debt can't rise faster than income forever. So as debt rises faster than income, you have a debt cycle. What causes it to stop? Well, traditionally, as you lower interest rates, it has three positive effects. If interest rates are too high, then you lower interest rates. Lowering interest rates has the effect of making it easier to service the debt. It has the effect of making items cheaper to buy on credit because the monthly payments are less. It has a present value effect on assets. So if you lower interest rates and you have something that has a cash flow, let's say a piece of real estate or something, they have a present value effect. It causes those assets to go up. That produces wealth, and that allows more borrowing. And so when you get to a situation where you can't lower interest rates anymore, let's say you hit zero, that part of the cycle ends. So then you go to a deleveraging. Now, a deleveraging means that you can't raise debt relative to income anymore. When you can't raise debt relative to income anymore, the cycle begins to work in reverse.
And so is the almost $80 billion we will pay in interest this year on the national debt.
And so what we've seen is that as throughout history, we can go back literally thousands of years, as the debts rise and there's somebody's financial assets, there's a balancing act that becomes increasingly difficult. And so when we look at what's ahead, we do know how these cycles work. We know that you have a recession to a recession, and on average they've been about 7 years, and they're shorter when you start quicker. And so we're in a cycle where there was a lot of money and credit. I mean, from an investor's point of view, think about how bad that debt is. I'm holding cash. Last year I lost 7% to cash. One would have lost 7% in buying power. And now if you have a 5% inflation and so on, the things are changing. And so because they're changing in that way, inflation psychology is going to change. They don't want to hold the bonds, or they don't want to hold the cash, much less. And so we have an extra risk that they may sell those bonds and that cash. And when they do, then that creates a bigger deficit in funding, because not only do you have to sell the Treasury, what the Treasury has to sell, there has to be enough buying to buy what the sellers are selling. And when that comes up, it puts the central bank in the position of either having interest rates rise a lot, and that shuts things off, or having to come in and fill the gap in a bigger way than it was done before. So we, as that psychology changes and wages change and all of that, we are on the brink of that happening. So yes, we have a big issue pertaining to inflation. The trade-off, it appears to me, that a high enough interest rate to adequately contain inflation of what we might think is adequate is too high of an interest rate for the markets and the economy. So that the trade-off that the Fed is going to face will be an even greater, more difficult trade-off between inflation and growth. Think about it. The tightening that might be priced into the market might take it to 2%, maybe give or take a bit. 2% interest rate, when you have something that could be a 5% inflation rate and you have the supply-demand imbalance, is something that is really a problem.
Any prospect?
I think that the Fed's forecast that it was transitory was obviously wrong. Okay? I think they are misunderstanding things. I think they put too much on the cycle, a normal cycle. Why are real interest rates, since we started, when we started setting inflation index bonds, they were 4% real. Okay, how did they get to minus 1%? Why is the equilibrium in interest rates 500%, 500 basis points lower than it was back then? There's something bigger going on. And that bigger thing that's going on is the accumulation of debt, because that's buying power. That's stored buying power. So everybody's got to believe that that stored buying power is real. Yet if you think about how are you going to get that? Can everybody sell those bonds and actually convert that into purchases? No way. So if you look at history, throughout history, there's this bigger thing that's going on, this bigger debt cycle thing that's going on. And so I think there's not enough attention paid to that.
Hopefully, the video was informative and enjoyable. Don't forget to push the like button, and if you're new, subscribe and click the bell icon for more updates.